Hi there, ladies and gentlemen. Thank you for joining us for yet another live webinar. Today, we'll be discussing Toolkit for investing in Singapore and how you can get ahead. Bolstered by sound policies and the resilience of the Singapore market, the outlook for Singapore's investment opportunities has continued to look bright despite global uncertainties. While investors are taking a second look at investment possibilities in Singapore, many questions and challenges accompany that. And today in the studio we have Deputy Chief Investment Officer at Phillip Capital Management, Mr. Teck Leng, as well as ETF product specialist at Lion Global Investors, Ong Xun Xiang, as they share the views on Singapore as an investment market, and as well as their approach to investing and the key themes that present opportunities, which are some items, key points that you might want to take note of. This webinar will also cover why the Lion-Phillip S-REIT ETF is a good alternative for investors looking at sustainable passive income stream, and how the Lion-OCBC Securities Singapore Low Carbon ETF can be a strong contender for portfolio diversification. We have our speakers in the studio, and I'll give them the opportunity to tell us more about what they're going to share very, very shortly. But first and foremost, let me do a very quick poll with you. Can you hear me loud and clear? Yes, all right, great. Thank you for the resounding yes. Thank you so much. Without further ado, let me hand the reins over to our first speaker. That's none other than our dear friend Teck Leng, to take us through the potential opportunities in the market that you might want to keep a keen eye on. Teck Leng, if you're all set to go, I can give you sharing rights right now.
Yes, thank you, Sri. All ready. You can pass me the control.
Hey, Xun Xiang, if you want to turn off your webcam for the time being, you can do that as well. Then we can have the full screen view from Teck Leng.
Okay, so I suppose everybody should be able to see the screen that I'm sharing.
Yes, we can.
Okay, thank you, Sri. Okay, well, I got quite a fair bit to cover, so without further ado, I'll just plunge straight in. This is the agenda that I'm going to be covering for today. Firstly, I'll talk about general market outlook, both for global as well as Singapore as well. Then I'll follow on with talking about Singapore REITs as a investment segment, and after that, the product itself, which is the S-REIT ETF, which gives exposure to this segment. So this chart is to give you a overview of the performance of the various asset classes over the last 2 years, calendar year 2021, calendar year 2022. Blue one is for 2021, orange is for 2022, all normalized to the same currency, US dollars. You can see that on the left, the two are referring to the Singapore asset class, Singapore Index STI, and then Singapore REITs. And then the rest of you have the next three are equities, Asia Pac, S&P 500 and Nasdaq, of course, US. Then last three, global bonds, gold, and finally general commodities. As you can see, the year 2022 has not been kind to equity investors in general. Even REITs, Singapore REITs also had a downturn. Singapore equities in general actually were positive for last year, surprisingly, and that was largely due to the banks. Another segment that had strong performance last year was commodities, because as you know, inflation was a big topic the last 1.5 years. So commodity did benefit from the reflation story, recovery from COVID, reopening, and then subsequently inflation. This is the performance for stock markets so far this year in 2023. So after a quiet start for you can see that actually in STI, which is the red line, it has basically been up and down, and then going back more or less to the same point as of last week, right? While the Hong Kong has had a more volatile ride, but more or less similar in total performance year to date. And finally, US has had a resurgence after the weak performance last year. 2023 has been quite kind to tech stocks, right? No doubt, because people do see that there is a possibility of the Federal Reserve reaching the peak hikes, so-called peak rates scenario. That means they are, as you know, recently they just paused their rate hike trajectory, and people are expecting them that they will hold off for some time. So that is actually propelling some of the tech stocks and leading them to have a resurgence so far, right? Now, but fundamentally, I think it is important to appreciate, some of these final points. First of all, what is driving the narrative is still inflation. So it's no longer COVID, which was the last 2-3 years, right? But nowadays, it's inflation dominating the narrative. And so far, since fourth quarter of 2022 onwards, because of a tapering of inflation, the headline inflation itself, there's allowed markets to catch some breath. And that is the reason why, that has allowed the Federal Reserve to slow down its pace of rate hikes, right? So that's shown by the red line. You can see that it's actually come down quite a fair bit now. It's 4.4% year on year. And the bottom chart really shows the key drivers of inflation. And it's important to appreciate that, the rate, well, of course, this one was taken from late 2022, and starting from, so that dotted line is actually projections based on one of the broker forecasts. But it does give us some appreciation of the drivers of inflation. In 2020 and early 2021, the key drivers of inflation was so-called goods-driven inflation. Goods meaning manufactured goods inflation. And the cost of manufacturing goods and transporting them to the final destination was what was driving up costs and the prices of end goods over this period. But since then, you will see that the blue segment, which is the services-driven inflation, has been and is expected to be the key driver of overall inflation now and going forward. Things like other services, healthcare, shelter, right? Generally services. And what is services driven by? What is the inflation from services driven by? Essentially is wages. And because wages have been sticky upwards, that's the reason why inflation has continued to be quite sticky. And I think it is my thinking that, and also many analyst expectations, that the inflation going forward is likely to be harder to combat from here, because wages are stickier than the inflation driven by goods, which has since come down and become a much less of an inflation driver. And there is a fine line between inflation and recession. Because of inflation, the Fed has had to deliver rate hike after rate hike. But because of that, you can see that certain segments, such as housing sales, such as manufacturing in the US, they have been on a weakening trend since second half of 2022 onwards. Especially if you look at the lower chart, manufacturing. The US Manufacturing Purchasing Managers Index, which is an indication of the supply chain managers' expectations of the manufacturing trends going forward. They actually are seeing inventory accumulation decisions has been on a contractionary trend since fourth quarter of 2022. Note that 50 is the line that divides between expansion and contraction expectations. Okay, so since last year already, expectations of manufacturing has been bearish. So another commonly watched indicator is the 10-year minus 2-year spread. 10-year meaning 10-year US Treasury bonds yield, 2-year meaning 2-year US Treasury bond yield. So whenever the difference between the two, in common situations, usually the 10-year yield is higher than the 2-year yield, which is why normally this line, this chart spends most of its time in above zero, right? But in periods when it is in a protracted period below zero, it tends to lead on to recessions. So you can see that in the green circles refers to periods when it's below zero, and it's typically followed by recessions, which is the beige color bands, which indicate the recession period. So for us in this current period, we have spent quite a fair bit of this spread below 0%, okay? Which is why people have been quite cautious about the economy, both now and I think over the last few months, right? So this is really something we need to be aware of. China reopening, okay, I wouldn't spend too much time about it, but essentially there has been some expectations that China has, because of its reopening from COVID, reversal of zero COVID policy, there is some stimulus to the economy, right? And also people expect that the central bank is loosening policy, that means cutting interest rates, and is turned from previously clamping down on the property sector and tech sector. Right now, the regulatory tones have been softening on property sector and on tech sector. And even in foreign policy, right? I think we expect that in terms of the foreign policy towards their US, towards the West, they have been more reconciliatory. So at least for this, there is some positive tones, right? In March, the problems with the banks, as you will remember, Silicon Valley Bank and some other banks had problems, leading to Credit Suisse merging with UBS, right? So this has since faded into the background. About being too aggressive in its raising of interest rates, right? It is also something that bears watching. Typically, when the interest rates have risen at such a fast pace, something would break. So hopefully, the regional bank crisis in the US in March this year was the beginning and the end of such a possible financial crisis, right? But also we need to watch. Now, turning on to Singapore, some things to note. So Singapore has been what you would say somewhat of a bright spot, right? In terms of the economies, because for example, we have been welcoming a lot of foreign domestic investments, as you can see here. ASEAN 5, out of the ASEAN 5 investments, we have been attracting a lot of that share, the FDI. Manufacturing, I think we follow, our manufacturing situation follows that of global situation, which is on a declining trend, as you will see on the right-hand side. On the left, you see the US. On the right, you see Singapore non-oil domestic exports. It's on a downtrend. It's been contracting over 10% year on year, minus 10% year on year or more. Okay. However, on the services segment, such as tourism, it is strong. You can see on the top chart, monthly visitor arrivals has been, surging year on year. Below, you can see hotel RevPAR. RevPAR is basically the revenue per available room, which is basically the room rates, per room hotel rates times the occupancy rate for a hotel. And this number has been very strong year on year. at the current moment. So the tourism is strong, hotels strong, and that's to be expected because of a COVID reopening. Retail sales in Singapore has also been very resilient. So that is also something that we should draw optimism from, right? The blue bar chart basically shows the retail sales over the last for every month from 2020 until 2023, right? So it remains resilient, right? Except of course 2020 there was a big drop because of the COVID situation, right? But since then retail has been pretty resilient. So there are some of these positive points, and of course I think residential, all of you will know that residential property has been one of the highlights of the Singapore economy over the past 2-3 years, even through COVID, right? And residential rents, residential valuation, home valuations, right? So that's been going from strength to strength. No doubt it has been helped by foreign inflows, not just of the FDIs that I showed earlier, but also wealthy foreign investors have also been putting their wealth for management in Singapore. So Singapore's emergence as a financial center, not just in Asia, but now increasingly the global financial center, has continued to go from strength to strength. Okay. So that is the overall situation that we are seeing right now, right? In summary, basically a much more muted inflation situation, but going forward possibly more sticky, and that may lead to the Fed holding interest rates for a higher for longer, through a higher for longer interest rate situation, which means that don't expect that the Fed may lower rates aggressively in the near future. Possibly they might just look to hold. And globally, I think services remain strong, and manufacturing has been seeing a weakening trend since fourth quarter of last year. And in Singapore, more or less, it reflects those global trends, right? Singapore tends to be a canary in the coal mine. It tends to be well leveraged to the global economy. So it also, the breakdown of the Singapore economy in terms of the growth drivers also reflects global trends. And I think right now, Singapore's situation, employment-wise, it also remains pretty tight, and that is probably a good thing for everybody too. Next, I'll go over the REITs in general, right? Why are Singapore REITs attractive? Okay. First of all, I think it's worth highlighting the importance of dividends. First point, dividends are typically funded from company reserves, and it tends to grow in step with profits, and that is a key reason why dividend signaling. When companies grow their dividends, they're signaling that they expect the profits outlook is pretty resilient or good going forward. Secondly, there's consistent evidence that dividend-paying stocks significantly outperform non-dividend-paying stocks during bear market periods, right? So, in other words, dividends is an anchor in bad times. Okay. And thirdly, a commitment to dividends is a commitment of the company orientation with shareholders, right? It's a signal that the company is prepared to pay dividends in step with its profits. So it's not going to keep all its profits for itself, right? And dividends, therefore, a lot of people, and of course, I think lastly, a lot of people do like receiving dividends in their meal, right? I mean, it's as a income source, passive income source, it's pretty important for investors as well. Okay. Secondly, Singapore as a investment destination. You can see that this is a chart of the Singapore dollar against the US dollar over the last 30 years, from 1990s till 2022, right? So if you annualize that appreciation of the Sing dollar against the US dollar, is about 1% gain against the US dollar per year. That means annualized 1%, right? And that is one key reason why why people would buy Singapore assets, right? Because you don't see a weakening of, you don't you actually don't see a erosion of your buying power, but actually, even if your assets remains more or less the same in valuation over a long period, but you actually gain in terms of the currency exposure itself. And lastly, the long-term attractive returns of S-REITs. So this is a chart that is taken from SGX Research S-REITs chart book, June 2023. And in this chart, you can see clearly Singapore REITs as reflected by two lines. One is the blue line, which is these two indexes, the blue and the green, actually refer to two indexes that both track the Singapore REITs as a whole. So one is IH, one is FTSE Singapore REIT. So that's why they are so close, right? But you can see their clear outperformance against the STI Total Return Index over a 10-year period from May 2013 to May 2023. And when you say total return, that means both capital gains plus dividend gains, dividend income, right? So that's total return, right? Because when you invest an investor, you gain in two ways. One is dividend income, one is capital gains. Now, you can see that Singapore REITs as a whole, as reflected by the two S-REIT indexes, it has had a strong return track record against the broad market, which is the STI index. Okay, so all these are reasons why that Singapore REITs have actually become a much watched asset class within the Singapore markets, right? And that is the preamble to what I'm going to be talking about here, which is the product, one of the market products that enables you to have quick exposure and easy diversified exposure to this S-REIT asset class. And that is the Lion-Phillip S-REIT ETF. The S-REIT, well, I mean, the name itself is self-explanatory, right? It's a partnership between Lion Global Investors and Phillip Capital Management, right? And it is, the index is a license from Morningstar as the index provider, right? And it invests into Singapore REITs, and that is why it's called the Lion-Phillip S-REIT ETF, right? Now, it gives you easy access to sustainable income from a resilient portfolio of high-quality Singapore REITs. It's typically between 20 to 30 Singapore REITs, okay? So this number may change. That's why we are putting asterisk here. The 25 may change, right? Depending on the rebalancing at every half year, okay? But typically it's between 20 to 30s within the portfolio. Now, key features of this Lion-Phillip S-REIT ETF, right? So 1, 20 to 25 high quality Singapore REITs screened by Morningstar, which means that, just by buying one S-REIT ETF, you have exposure, you have quick exposure to a basket of S-REITs that are high quality and is easy diversification because 20 to 25 of them all within this basket in the ETF itself. Second point, rebalance semi-annually in June and December. So we just had our last rebalancing last Friday, incidentally. Then the next upcoming one is in December. So it's rebalanced semi-annually. And why do you rebalance? Well, because you want to make sure that the portfolio is not static, but it is constantly being renewed according to the index methodology by Morningstar to ensure that the highest quality and the best REITs are captured in the ETF portfolio, right? That's the reason for rebalancing. Number 3, the diversified portfolio with up to 10% weightage cap, which means every time we rebalance, we ensure that every REIT does not have more than 10% of the whole ETF, right? So that's to ensure diversification, because why would people buy ETF? One of the key reasons is to ensure diversification, right? Well, fourth key feature, semi-annual distribution, which we typically announce in January and in July, right? So investors would thus look forward to semi-annual payouts from this ETF, right? And to talk about this ETF methodology in more detail, right? Basically, what happens is we start off from the left in a selection universe of Singapore REITs, which would number about, right now Singapore REITs in Singapore would be about over 40 REITs, right? But we are not going to be buying all these 40, because the reason is after screening for these following three factors: quality, business quality; second factor, financial health; and then thirdly, the valuation, which we use dividend yield to as the valuation consideration. Now, the best REITs with high business quality, high asset quality, for example, high management quality, the best REITs with good financial health, and the best REITs with attractive dividend yield. Now, all these together, they will modify their weightage of the REITs based on the original universe. Then finally, we would check these REITs selections based on their liquidity, because we don't want to be buying for this ETF REITs that are too illiquid. That means they are too thinly traded. Because sometimes that will reflect inefficient pricing and so on, right? So finally, after adjusting for all these, then you have the Morningstar Singapore REITs Yield Focus Index, which this ETF is basically tracking, and which basically the semi-annual rebalancing is trying to rebalance towards every time semi-annually, right? So the long and short of it, this REIT ETF is designed to hold high-yielding REITs with superior business quality, with superior financial strength. And financial strength increasingly becomes more and more important, because in this high interest rate environment, you can bet that there will be companies that, if they don't manage their finances properly, they'll be having to pay much higher interest rate costs. They might even be facing balance sheet pressure, right? So financial health is becoming increasingly important. And this is just a summary of the portfolio, right? As you can see, this ETF allocation is quite well balanced towards the various key REIT subsegments, such as industrial, retail, specialized. Specialized meaning like data centers, right? Then it also has exposure to office, hotel, healthcare. Okay, and the trailing some things to highlight: the trailing 12-month dividend yield of the underlying constituents of this Lion-Phillip ETF, which means that the weighted average of this the weighted average dividend yield of the constituent now is at about over 5%, about 5.4%. And the AUM for this ETF is 320 million as of end May 2023. So you'll be buying into a very quite a well traded and very substantial ETF itself. These are just some of the names, the top 10 holdings in the S-REIT ETF. Okay, I expect many of them, probably all 10 of them, are familiar names to every one of you here, right? And this is the distribution history, right, for the S-REIT ETF. So as I mentioned, semi-annually there's a distribution by the Lion-Phillip S-REIT ETF. So you can see that the distribution has been pretty stable or sustainable. The blue chart basically shows in Singapore cents terms, Singapore cents per unit. So for example, in March 2018 was 1.68 cents per unit, right? 1.8 cents. So over the past few half years, it's ranged between about 2.5 to 3 cents per unit. Okay, so that gives you a sense that if you are looking to invest into this REIT ETF, to have an expectation of something like this per unit over the next half year or next half year, and the next half year following that, and so on, right? This has been the distribution history so far. Okay, and I think I will stop here so that Xun Xiang can probably move on to the next product. Okay, then I think towards the end we might have some time, about 10-15 minutes for Q&A. Okay, thank you very
Thank
much.
you so much, Teck Leng. Thank you for the insightful sharing. Members of the audience, if you have questions, you can type them in the question box. We have a Q&A segment rather at the end, so we can have all your questions addressed by our speakers. All right, next up is Xun Xiang. Is going to walk us through a new ETF that focuses on low carbon. Interesting. And that promises to offer diversification for our portfolio. Xun Xiang, if you're all set to go, I'll hand the reins over to you right now. Let me give you sharing rights, okay? All right, great, Xun Xiang. You should see a problem on the screen. There you go. I see your slides. Let's have it on full screen view, and you can start anytime right now.
All right. Good evening, everyone. Thank you for joining us tonight, and thank you to Sri for inviting Teck Leng and myself here tonight. I'm Xun Xiang from Lion Global Investors, and you can call me the ETF guy. So far, basically, we have heard Teck Leng share about Singapore's market outlook and also the Lion-Phillip S-REIT ETF. So for my own sharing, I'll discuss about how you and I can invest in both Singapore and ride on the low carbon trend through ETFs. And before talking about ETFs, let me first introduce about LGI first. So LGI, we are the asset management arm of OCBC Group, which is the longest established Singapore financial services group and Southeast Asia's second largest financial group by assets. And besides LGI, OCBC Group also consists of Great Eastern, which is our parent and the insurance arm, and also Bank of Singapore, which is our private banking arm. And today we are also one of Southeast Asia's leading asset managers, managing up to 70 billion Sing dollars of assets. So we basically started our ETF journey back in 2017 when we listed our first ETF, which is the Lion-Phillip S-REIT ETF that Teck Leng covered earlier. And between the period of 2020 to 2022, we listed 3 ETFs within 18 months. And within 5 years, we built our ETF business from 0 to 800 million today, with support from investors like you here. And based on SGX data, as you see here, as of the end of May, our ETFs are also within the top 10 ETFs held by Singapore retail investors like you and me here. And similarly, based on also SGX data, as of May this year, our ETFs are also among the top 10 ETFs held by SRS and CPF investors. So with all these said, we are strongly rooted in Singapore. And this is because Singapore is our home. We are well known for being the first in many areas, such as the top global business hub and the #1 global financial and also global innovation hub. And in Singapore, we are given the opportunities to dream big and achieve bigger. So right now, let's watch a short video about how we dream big and achieve bigger. So Sri, can I trouble you to play the video?
All right, this is my cue to play the first video. I'm gonna take back sharing rights from you, and very quickly click on the right video that we can share. Okay, this is it. Members of the audience, just a heads up in case it's a little too loud on your end. Just adjust the volume accordingly. So I'm gonna play the video right now. Let me know if you see it, Cynthia. Wow, that's a truly amazing video. Gives you so much hope for the future, doesn't it? All right, Xun Xiang, and here I'm gonna share the reins back to you. The time is yours.
Yep, thank you. Okay, so thank you Sri for playing the video. And what I wanted to say is this video ended with a line that strongly resonates with me. Business is not just business; it is a force for good. And in the 2022 Singapore International Energy Week, DPM Lawrence Wong himself announced that Singapore will commit to net zero by 2050. Specifically, we acknowledge that net zero by 2050 is a stretch, but he also highlighted that Singapore wants to do our part. And because despite being like just 0.1% of global emissions, Singapore has a big role to play in pushing for net zero globally. And so with all these happening, Singapore is not just a little red dot. We are also a little green dot. And we need to be a little green dot because climate change affects everyone. For investors like you and me, climate risk is both an investment risk and financial risk. So many of us currently do not actively manage this risk within our portfolio. And basically, there are two types of climate risk. The first type is physical risk, which is easier to understand as we have been experiencing more extreme weather patterns that have triggered natural disasters, loss of lives, and loss of wealth. And the recent examples we see are the Genting landslide or the earthquake we have seen in Turkey. The second type is transition risk, which is harder to understand and is brought about mainly by policymakers. So, for example, the Singapore government recently announced additional carbon tax to force businesses to transit to a lower carbon future. And specifically, Singapore's carbon tax will increase to around 50 to 80 Sing dollars per ton of CO2 emissions by 2030. So right now at this stage, Singapore's carbon tax is already the highest within Asia. And so for companies that are unwilling or unable to reduce their carbon footprint, they may face a lower share price or lower access to funding. So as investors, we need to be aware of this financial risk created by climate change and protect our portfolios against this. So more than ever, we need a 21st century and green version of the STI. So investors like you and me gain a convenient and affordable way to invest in Singapore's low carbon transition. And before I continue sharing about the ETF, let me say happy birthday to the Singapore Low Carbon ETF because it just passed its first birthday on the April of 2023 this year. This ETF basically has three key features that helps you participate in Singapore's transition to a lower carbon economy. First, by tracking the Lion-OCBC Singapore Low Carbon Select 50 Capped Index, you gain access to 50 Singapore companies committed to a lower carbon footprint. Second, a 7% and 10% weightage cap are applied on individual stocks. So you build a diversified and decarbonized portfolio. And third, this is Singapore's first low carbon ETF, and it will make semi-annual distributions. So for investors like you and me, this ETF is a convenience and affordable way to decarbonize your portfolio. And this ETF can decarbonize your portfolio because the index is specifically built to minimize the portfolio's weighted average carbon intensity, also known as WACC, which means tons of CO2 emissions per $1 million of revenue. And when compared to the STI and MSCI Singapore Index, you can see here that the index has the lowest WACC of 53 as of the end of March, which is its latest rebalance, emitting the lowest CO2 per $1 million of revenue. And between the ETF's listing date and the 31st of May, the ETF has shared comparable performance with other broad-based Singapore ETFs, such as the two STI ETFs and the X-Trackers MSCI Singapore Users ETF. So this explains the benefit of having a securities weightage cap, which helps increase diversification, reduce volatility, and improve risk-adjusted returns. And they clearly show that you do not have to sacrifice returns in a low-carbon portfolio. And in this index, you can also see that it covers constituents that are listed in Singapore, Hong Kong, and US, demonstrating greater geographical diversification and wider coverage of investment opportunities compared to MSCI Singapore and the STI. You also enjoy greater sector diversification due to the 7% and 10% weightage caps. And the weightage in defensive sectors such as real estate is higher, together with greater allocation, as you see here, to consumer discretionary, which saw higher net institutional inflows in the whole year of 2022 and in Q1 of 2023. So all these provide well-rounded exposure to Singapore's economy while decarbonizing your portfolio. And here are also the top 20 constituents, where you also see and find Keppel Corp here, which is one of the top performing Singapore large cap stocks in Q1 2023. You also see C, Grab, and the 3 Singapore banks inside. And if we dive even deeper, the top 10 constituents of MSCI Singapore and STI accounted for more than 70%, while the top 10 of this index only accounted for roughly 57% as of the 31st of May. So all these show the benefit of having a weightage cap to ensure diversification across stocks and sectors, and to reduce volatility and improve risk-adjusted returns. And with these key features, you do not have to take excessive risk or sacrifice returns when you decarbonize your portfolio. So this helps you get the best of both worlds, where you do good for our planet and for your portfolio. And among these constituents, I want to share about 2 Singapore companies that have been doing good but are under the radar. The first company will be C Limited, which is the high-profile owner of Garena and Shopee. So basically, if you play video games or do online shopping like me, you know C Limited. But what many do not know is its active efforts in reducing carbon footprint. So for example, Shopee and Unilever recently collaborated to promote sustainable lifestyle choices to reduce plastic packaging by 75%. And after a series of successful cost-cutting measures, Forrest Lee announced that C has innovated to do more with less resources. And in March this year, C announced its first ever positive net income of $422 million. So this growth momentum also continued when C Limited announced another profitable quarter of 87 million net profit in Q1 this year. And to signal its turnaround, Forrest Lee also announced a 5% pay raise for most C employees that will be starting and be effective as of starting on July this year. And when comparing against the average target price set by analysts, there's been more than 56% of upside potential identified. And another company that has taken active steps to reduce carbon footprint will be Flex Limited, which is a low-profile Singapore domiciled company. It's the world's 3rd largest electronics design manufacturer by revenue. This is also a giant that is committed to reduce half of its Scope 1 and Scope 2 carbon emissions. And similarly, Flex has also done well financially, with its CEO sharing that it has delivered a very strong year, growing revenue by 17% year on year to $30 billion. And despite unfavorable conditions, its SolarTech subsidiary, which is known as Nextracker, also raised more than $630 million in its US IPO in the 8th of February. And in the recent fiscal year we just ended, around 31st March, Flex also achieved record high adjusted earnings per share and this is the 3rd consecutive year of it displaying 20% EPS growth. And when comparing against average target price, there's also been upside potential identified. So when we invest, we want to invest in the right companies that grow. With C and Flex, we see 2 complementary companies C is a high-profile growth company. And on the flip side, Flex is a low-profile value company. But through these ETF, you get a diversified blend of both growth and value stocks bundled together, while decarbonizing your portfolio and doing good for the planet. So you gain three benefits by buying the ETF. First, you'll be taking action to tackle climate change and support Singapore's low carbon transition. Second, you gain access to 50 Singapore companies that are both local and foreign listed. And lastly, a decarbonized portfolio helps you manage investment risks created by climate change. And to summarize, the Lion-OCBC Securities Singapore Low Carbon ETF instantly offers you diversified exposure to 50 Singapore companies that are committed to a lower carbon footprint. This ETF will be an efficient and green building block to your portfolio. And with just $1, you will be able to participate in Singapore's low carbon future today. So please log on to the Phillip Nova platform now and ask everyone you know to search ESG for the Sing dollar counter and ESU for the US dollar counter to buy this ETF. And before officially starting Q&A, I want to share about a short video on what LGI and SGX recently did for Mother Earth on a Saturday on 15th of April. And in short, what I want to say from this video is that we walk the talk. So Sri, can I trouble you to play the video?
Hey, Xun Xiang, sure. I'm gonna take presentation rights right now, and then I'll share the video from my side. Okay, let me look for the video. Second video. All right. The We Talk the Talk video. Okay, I'm gonna play it right now. All right, thank you so much for tuning in to the video. Xun Xiang, I'm gonna hand the reins back to you.
So thank you, Sri, again for playing the video. And to summarize from this video, what I want to share is that we want to do good for your portfolio and our planet. And that's why we launched the Singapore Low Carbon ETF for you. And we have also covered a lot today. And as you understand by now, we are facing an increasingly volatile market. So to ride out the volatility, it's important to have exposure to safe havens like Singapore. So this will be where the two ETFs comes in, by providing you efficient and stable building blocks for your Singapore portfolio. The S-REIT ETF, which Leng covered earlier, aims to provide a sustainable passive income stream, so you enjoy greater certainty of income. And with the recent market volatility that's been happening, the longer-term trend of decarbonization is also gradually unfolding. And this will be where the Singapore Low Carbon ETF comes in to decarbonize your portfolio and help you participate in Singapore's low carbon transition. This is the green building block that will do good for your portfolio and the planet. So I hope today's session has been useful to help you understand about investing in Singapore and Singapore's opportunities through ETFs. Thank you for being a great audience, and Teck Leng and I will now address your questions. Thank you.
All right. Okay. First things first. Xun Xiang, since you're here right now, first question for you is, what would be your top 3 takeaways for the low carbon ETF?
So the top 3 takeaways we would have about the low carbon ETF would be actually to understand about the 3 key features. So first, by tracking the Lion-OCBC Singapore Low Carbon Select 50 Capped Index, you gain access to 50 Singapore companies that are committed to a lower carbon footprint. Second, weightage, the 7% and 10% weightage cap also are applied on individual stocks. So you build a diversified and decarbonized portfolio. And third, this is Singapore's first low carbon ETF that will make semi-annual distributions. So to summarize these 3 key takeaways, for investors like you and me, this ETF is a convenient and affordable way to decarbonize your portfolio.
Right, Teck Leng, I hope you're still with us. Quick question for you. What would be your top 3 takeaways for the members of the audience today? I'm going to give you sharing rights right now in case you want to present something on your slide.
Top 3 takeaways. Firstly, is in terms of buying a REIT ETF, you are getting exposure to a diversified basket of REITs. That's one. So that's diversification. 2, you are getting exposure to a basket of quality REITs, right? So the word is quality, and that is ensured through our screening for the ETF, right? Which emphasizes on business quality. It emphasizes on financial quality, right? And third takeaway point is, if you are looking for something to give you regular income, then this would be one ETF you can consider, because by its nature, Singapore, the underlying S-REITs are very sustainable kind of income because they derive from rentals, right? So as you can see from our dividend track record for the S-REIT ETF, it has been quite sustainable and on a long-term growing trend. Okay, so these are the top the 3 things, takeaway points for this ETF: diversification, quality exposure, and sustainable dividend income.
Teck Leng, one more question for you before I hand some questions to Xun Xiang to address. The next question for you, Teck Leng, is understand there's been quite a bit of buzz about S-REITs at the moment. It has much to do with how the interest rates are evolving at this moment in terms of in the US dollar. How is this going to affect S-REITs, and why is there so much more interest right now on S-REITs?
Well, there are a few facets to this. So investment-wise, S-REITs have actually, for right or wrong, they have tended, in the short term, their share prices have tended to move with interest rates. And that's why when interest rates were hiked so fast and so high in 2022, so REITs were affected quite a fair bit, right? That's why they underperformed relative to the Singapore index last year. So that's and because to some extent people would then think interest rates, if I can buy government bonds at 3-4% yield, why would I take extra risk to buy into equities such as S-REITs right? So that's the reasoning. S-REITs, but of course S-REITs now they trade at 6% yield on average, so that's so they become still more attractive in terms of dividend yield compared to Singapore government securities, right? So that's one in terms of interest rates. So and right now we are talking about interest rate pause, big interest rate in scenario, and so on, right? So I mean, possibly, right, in this kind of environment, what came down would start to come back, right? Because if interest rates cause S-REITs to come down, then a reversal of that probably could do the same to S-REITs, right? So that's probably one line of thinking. And secondly, I think interest rates actually do affect Singapore REITs or companies in general to some degree in terms of their earnings as well, because especially, for example, for Singapore REITs, their assets are partly financed by debt, right? So if debt servicing cost goes up, then there is some pressure on their earnings as a result, right? Because less the revenue minus a higher interest cost means less income, net income. But don't forget that REITs, especially the high quality ones, are in a position to raise their rental as well. So top line also would have the ability to go up, right? It's different from bonds. Bonds is fixed income, it's really fixed coupons. Whereas for equities and REITs, broadly speaking, they have the ability to grow their revenue, and in a inflationary environment, you just have to look at residential property, right? Because after all, what is REITs? REITs are basically a collection of properties, mainly commercial, industrial. Now, if you look at residential, you have the residential valuations have gone up, rental income has gone up by as much as 30-40%, right? From maybe just 1-2 years back. So essentially, that shows how an inflation environment actually does benefits some of these stocks and REITs generally, right? So I think it's important to remember that.
All right, thank you so much, Teck Leng, for that insightful explanation. Xun Xiang, okay, I have a couple of questions for you about the low carbon ETF. Yes, the world is going green right now. Everyone wants to offset their carbon footprints, and closer to home in Singapore, we've all been given little blue boxes by the government to encourage all of us to start recycling. So the movement is certainly on, but why should investors care about climate risk, and why should an investor consider buying the low carbon ETF?
Okay. Thank you, Sri, for the question. So we should all care about climate risk because it's both a investment risk and financial risk. So basically, it's a physical risk, which we have seen for extreme weather patterns that have triggered natural disasters, loss of lives, and loss of wealth. And secondly, there's also transition risk arising from climate risk, which affects investors and that are unable to invest in companies that are unable or unwilling to reduce their carbon footprint. So either through this impact can be felt through lower share prices or lower access to funding. And especially because Singapore is a little red dot, we are especially and particularly vulnerable to climate change. And our leaders recognize this. As I also covered earlier, DPM Lawrence Wong himself has announced that Singapore will commit to net zero by 2050. And with all these happening, Singapore is not just a little red dot, but also a little green dot. And all these highlight the strategic importance of decarbonization and climate risk for Singapore, because climate change can affect your investment returns.
Well explained, Xun Xiang. All right, so we have come very close to the end of the segment. In this segment, I'm gonna first ask Xun Xiang. Xun Xiang, is there anything else that you think would be pertinent to an investor? I mean, of course, our attendees can ask more questions in the survey form at the end of the webinar, and then we'll direct those questions to you to address. But based on what we've discussed today, is there anything that investors would typically reach out and ask you about the low carbon ETF, and you think investors should take note of?
Until now, actually, what we have received one common question about the difference between the Singapore low carbon ETF and the other two STI ETFs. So I think since we're at the webinar, maybe I can address it. So for example, okay, since inception, okay, I want to set the context here first. Since inception, the Singapore low carbon ETF and the two STI ETFs have had comparable performance. And in fact, the Singapore low carbon ETF offers better diversification across stocks, sectors, and geographies. So in terms of the number of stocks, the Singapore low carbon ETF has 50 constituents, while the STI ETF has 30 constituents. In terms of geographical coverage, the Singapore low carbon ETF covers Singapore, US, and Hong Kong, while the STI ETFs only covers Singapore. And specifically in terms of real estate exposure, the Singapore low carbon ETF covers roughly 25% compared to the STI ETFs, which covers roughly 20%. And lastly, in terms of diversification, the Singapore low carbon ETF has a 7% and 10% weightage cap to ensure diversification across stocks and sectors, while the STI ETFs do not have any weightage caps. And that's why you see a lot of the banks being heavily weighted at up to 50% in the STI ETFs. And when we invest, we not only just want to invest in specific companies, we also want to build a diversified portfolio. And that's where the Singapore low carbon ETF comes in to provide the diversified exposure while helping you decarbonize your portfolio. So thank you.
All right, Teck Leng, I'm not going to let you off yet. So my question to you is somewhat similar, based on what you've shared about the S-REITs, and you've shared a little bit more about why it's gaining a whole lot more relevance right now in the present climate rather. What would be one of the frequently asked questions that you receive about the S-REIT, and why do you think it's important to share your views with the members of the audience, in case they are keen on this product and you think that this is a question that they want answers to? What would that be?
Well, I guess one common question that I get is from investors is why don't they why would they want to buy a REIT ETF, right? They say, oh, no, I might as well buy my own REIT myself. Well, and usually what I tell them is, well, I mean, if you do have strong conviction on that basket of REITs that you have, by all means, of course, right? Because you might get better returns from that than buying into a REIT ETF. But the reason for existence for a REIT ETF, like the Lion-Phillip S-REIT ETF, is basically it provides diversification to a basket, quick diversification into a basket of 20 to 30 REITs at one go. So very convenient. And when we say diversification, it's not diversification for the sake of diversification, because you're trying to limit single REITs risk, right? Individual companies, bad things can happen to them, things that you didn't anticipate when you bought into them. Your investment case didn't capture that, like recent ones, where they suddenly have problem of breaching their loan covenants or forex issues, because especially for REITs that hold foreign assets, they have forex issue because Sing dollar is so strong, right? When you convert that back to foreign income back to Sing dollar, suddenly you have an issue that the forex it doesn't translate that well back to Sing dollars, things like that. So what we are trying to do in a ETF is to have a collection of REITs that limits any such single REIT exposure, or for that matter, limits single subsector exposure, such as you don't end up having too much exposure to a certain sector, as if you had done if you just bought one or two REITs for your own portfolio. Okay, because the REIT ETF actually does have exposure to a variety of sectors, as I mentioned, industrial, retail, hotel, office, and so on, right? And I think there's another often missed point about an ETF like this, which is that if you buy a REIT or one or two REITs of your own, you have to keep monitoring them, and it's not just investment wise, but it's also when they raise capital, rights issues, and so on, right? You don't want to miss the rights issue, because typically it's raised at a discount to the market price, so you need to subscribe most of the time, right? And for busy people like you all, the REITs that you hold, you may miss some of these corporate actions. Now, when you buy a REIT ETF, the fund manager takes care of all this for you. So we will be monitoring the individual constituent REITs. When they have corporate actions, we will monitor, and then where relevant, we will help you to subscribe for these corporate actions, the placements, rights issues, and so on, right? So you don't have to worry about that for at all for your own REITs exposures, because that is handled by the ETF manager itself. So that's another key point that people often miss, right? So I'll stop here, right? So these are two good reasons why you should consider buying a REIT ETF itself, or for that matter, an ETF, rather than individual exposures, unless, of course, you have strong conviction on certain stocks. Then, of course, you should do that. Thank you.
All right, thank you so much, gentlemen. Thank you so much for your valuable insights. While we ponder about our watch list and which new products are probably going to be added in there. We thank you so much, Leng, for your insights on the S-REIT, and Xun Xiang for your sharing on the low carbon ETF, something to think about as we all want to care and cherish for our future. And if you have more questions from this for these lovely gentlemen, you can type them in at the end of the webinar in our survey form, and we will send those questions to this wonderful gentleman to address, and we will feature their responses in our follow-up email. All right, in the follow-up email, you will have a link to this video. The webinar is recorded, so you can catch up and revise on what was shared today, as well as find out more about the other upcoming webinars that we have. And thank you so much for your wonderful time, and thank you once again, Teck, Leng, and Xun Xiang.
Thank you. Have a good evening.
Thank you. Thank you, everyone. Have a great evening.
All right, thank you, members of the audience. Till our next webinar, take care, stay safe, and all the best we are trading for the rest of the week. Bye-bye.
Bye.